Welcome. This is Troy Patton. I'm with the Archer Funds. I'm one of the portfolio managers for the Archer Investment Corporation. And today I'd like to talk to you a little bit about the markets, not necessarily about the funds that we manage or the portfolios that we manage, but I really want to just spend a little bit of time educating everyone on the markets, the investment roadmap, and the detours ahead. So, for instance, we'll just start out on slide 3 and move from there. And we'll talk about not only the markets, bull versus bear. We'll talk about the bond market, currencies, gold, and where stocks are potentially headed. Okay. The next slide, on slide 4, where are we today? Well, as everybody knows, today the stock market's done unbelievably well. We're up nearly 25, 26, 27% on the S&P 500. Actually, when I printed this slide, we were just over 20% after September. We've done pretty well. Obviously, going into the end of the market, we've had a little bit of a sell-off here in this last week. But clearly, as you can see, compared to the rest of the world, we have done extremely well. The S&P 500, the stock market, has done better than not only the world markets, Europe, gold, cash, fixed income, high-grade bonds, you name it. Excuse me. In fact, gold has done very poor and may continue to do poor, and I'll explain why here shortly. On slide 5, basically what we're doing is we're seeing, and I know it's kind of a hard slide to see, but one thing that we always try to do is we try to estimate what the earnings are going to be for the companies for the next quarter, and so on and so on. And we always want to see whether those earnings are higher or lower than the previous year's same quarter, the previous year's earnings. And typically, if the trend is somewhere above 1.4 to 1, we typically see that as a positive outlook for the stock market. And we've actually seen that now for quite a while. We've had a little bit of a dip during the government shutdown, or prior to that, but the latest quarter has actually been very positive. And quite frankly, we expected the year-end target to be around 1775 on the S&P 500, and even as of this morning, we're at about 1800. It really doesn't mean that the market cannot move higher or lower. It just means merely that based on 14.8 times earnings, we expected the stock market to be at 1775, which was obviously quite a bit higher than the start of the year. Now, we've gone past that here and gone to 1800, and there's a reason why. It's not necessarily that the earnings are that much higher than the 120 mark, the base level that we've put into place here, but the target PE has actually climbed. And one of the things that, if you can see this on the slide, it says 2014 estimate earnings per share. This is what we're saying for next year. It's very possible, as we look forward to the earnings for next year and based on the target PE, where we're going to be. Now, just jumping here to the next slide, on slide 6, one of the things that we like to say, is this the 50s or is this the 90s? And again, notice that during the 50s, an era of low rates and high government deficits, that PE expanded. So this blue line here, you can see this blue line that goes up and down, it shows basically multiple expansion. And the way I like to kind of talk about this, and since we're based out of Indianapolis, Indiana, obviously we work with clients all over the country, but let's say Eli Lilly, which is a public company in Indianapolis, had earnings of $1 a share. And they traded at 15 times earnings. Basically, the stock would trade at $15, okay? Now, it's very possible, and in markets it's not uncommon, that sometimes that 15 multiple becomes 14, and then the stock goes to 14, and sometimes it goes to 16. And a lot of that's predicated on not only interest rates, but what's going on in the world, in the economy, everybody's outlook and for stocks and things like that. So, what we're saying is that right now, our multiple expansion, as shown on the very next slide, slide 7, has actually stayed relatively the same, actually since 2009. So the only reason that the stock market has actually climbed since 2009, since we hit those lows, is actually earnings have gone up. Earnings have gone up in nearly most companies. and we can see that the S&P 500, although we did this in September, taking this forward to today, we're getting close to around that 15 mark right now at 1,800 on the S&P 500. As you can see, years past in 2007 and before, the PE multiples or the forward PE multiples were quite a bit higher. In fact, it's very common to look forward to the next year and say, hey, where is the PE multiple going to be, and at what level is it going to be there? So just like, and I'm gonna backtrack here back to slide number 5. You can see that it's really pretty easy for the S&P 500. If we were to hit 125 on earnings in 2014, which I think is very likely, at a 16 multiple, the stock market would be at 2,000. Okay, in the lower right-hand corner it says year-end 13 target. Maybe that's the target for next year. That actually implies about a 10% increase in the stock market in 2014. Okay, all right. With that being said, what can push that multiple higher? Well, one of the things, if you see on slide 8 here, at 52% stock ownership, it remains well below the recent historical trend of plus 60% seen before 2009. Essentially, what we're saying here is that people are scared to get back into the market. Some people feel like they've already missed the market. They say, oh, it's going to go down, and then I'll buy in. The problem is we don't know, and I mean nobody knows. Nobody knows whether it's going to go up or down in the short term. What we do know, and we've experienced in the past, and remember that the United States is undefeated in comebacks, is that the stock market has moved higher, right? I mean, it's moved higher over time. But with that being said, we average a 10% correction, or actually more than a 10% correction each year for about the last 100 years. So oftentimes people always ask, they say, well, Troy, when should I get in the market? And the answer is, if you're going to be in the market over the long term, the answer is now, okay? Because inevitably is what we do is we tend to wait, and we say, I want to wait for a pullback. And I have people tell me that all the time. But the problem is they say, I want to wait for a pullback, but yes, there will be a pullback, but does the market move 10% higher before it corrects 7%? And if so, you missed out on 3%. Study after study has shown that people that are invested over time do much better, obviously, than people trying to time the market. Okay? So what's going to bring these folks back to the market? Really, I think it's really just going to be a matter of people feeling that they've missed the boat and they feel like they have to get in at this point in time. And then at that point, they'll all rush in, and it could actually move that multiple much higher than 16. In fact, you could even see another 15% plus gain next year, barring anything in the world that may offset that. Okay. On slide 9, basically, just to give you a really quick example, everybody knows what that is on slide 9 on the right. That's a Big Mac. And one of the things I like to point out is in 1972, if you had bought McDonald's stock and you sold it in 1982, and I'm going to go ahead and tell you that the income had doubled in McDonald's during that same period of time, literally doubled, would you have made money in the stock? The answer is actually no. And the reason is simple. The springs to the left, the market is like a spring. Sometimes that PE multiple contracts, and sometimes it expands. And it does so based on rates. And you have to remember that in 1980 to 82, we were facing 10-year Treasury yields of higher than 10%. Many of you, you may remember, interest rates on homes were 14 to 16%. Well, clearly we're not in the same boat today. I mean, they're in the 4s and 5%. So, but yet we haven't seen the multiple expansion that usually comes along with that. And part of that is because a lot of folks believe that the multiple expansion should be muted because the Fed has overinflated the balance sheet of itself by printing dollars. Okay? So the question is, are we bullish? The answer is yes. We've been bullish, and in fact, I'll show you in a little bit. I have a slide where we've pretty much predicted since 2008-9 where the market was going to be, and we've been pretty much right on track. We've never had a plus 20% return in the stock markets followed by a negative year. And that's never happened. And I always hate to say never because it always could happen. But given the outlook in the stock market and with the companies and the cash on their balance sheets and that sort of thing, they're actually the stock market may do very well. In fact, I'm anticipating somewhere between an 8 to 12% return next year in the stock market. Obviously, much better than the bond market, which very well could be negative next year. This is a slide that I've actually put on for I've been using it now for 2 years, and I haven't changed it because I think it's really interesting. Whenever we have 10 to 16 years of negative performance in the stock market, like we did, if you go from 1999 to 2009 and that sort of thing, it indicates a 20 to 25 year upcycle. And as you can see, I mean, this chart, I mean, it's really pretty prevalent. I mean, look where we've come since March 2009. If you remember, the S&P 500 was about 600, so it's gone up about 250%, 300%. Actually, not quite that. It's about 250, maybe even a little less than that. So you can kind of estimate, where that stock market is. We have a lot of room to go. Again, it indicates a good 20 to 25 year upcycle, and I still believe this chart is very relevant today. That you have not missed the boat. The stocks should continue to outperform bonds over the next, probably I would say 10 years. Okay, because again, the Fed has artificially kept interest rates low, and again, all that was on slide 11. On slide 12. One of the things we always have to remember is that earnings is an opinion, cash is a fact. Focus on cash flow. One of the investments that we put in a lot of our portfolios, and actually we are building a larger position for the folks that are with us, is we like to focus on companies that are buying back their stock or companies that can afford a dividend. And as you can see on slide 12, over in the far right, cash as a percent of total assets is really way up on the balance sheet of companies. Companies are healthier now more than ever. I mean, more than ever, and that's gonna bode well for them over the long term because they will have the flexibility to act, whether it be buying other companies, buying back stock, issuing dividends, all kinds of different things. Okay. This is a really interesting slide on slide 13, and this is something I think that's again, really interesting, but there are actually less shares of stock to be purchased today than there were in the past. You can see since 2008, companies have actually been buying back their stock. This kind of goes along with our theme that we want to buy companies that are buying back their own shares, because then it's simply supply and demand. If I was an ice cream vendor and there were 10 of us out there, and we all worked on the same corner, we'd have to lower our prices to compete somewhat on price. But now let's say there's only 2 left over time, or maybe I'm the only one. Well, by gosh, that's going to push my prices higher. I'm going to be able to, even if I don't sell as many ice cream bars, if I'm offering at a higher price, I still have better earnings. That's no different than in the stock market. The supply and demand, we have really seen not as many companies going public as there has been in terms of buybacks. In fact, many companies, one just the other day announced a new fresh buyback. John Deere, I think it was another $6 billion buyback. They're buying back their shares. Companies like Apple and Microsoft, those companies should actually go private. If they focused all their cash flow on buybacks, they could go private in 9 to 11 years. They could buy back all the stock that's out in the stock market. That would be something, right? Well, that helps those of us that are in the stock market by pushing prices higher. Okay. Slide 14 is maybe a little bit tough to see here, but this is one of the reasons I really think the stock market's going to do well over the next 10, 15 years. And I still think we're probably in a good upcycle here. Or that we would see a 10 to 15 year upcycle, and let's just say we're in year 5 of that at this point in time. We have really lagged the world in terms of construction spending. In fact, the U.S. ranks number 143. And if you can look over to the left, unfortunately, look who's number 144, Greece. Okay? At 13% of GDP, the U.S. is one of the lowest in the world, okay, following the 2008 recession. I mean, Hong Kong, Canada is even much higher than us. You guys have seen, obviously, on the news, I mean, bridges that fail and things like that. One of the things that can really boost our economy and our GDP as a whole is a good construction or infrastructure bill coming out of Washington. And I do think that's in the cards because, frankly, at the end of the day, the politicians, they just want to be reelected. I don't care what party you subscribe to, but at the end of the day, they want to be reelected. And to do that, they're going to spend money. And I think a lot of that money will find its way into the construction bills, infrastructure bills, the road bills throughout the United States. And really that bodes well for companies like Caterpillar, John Deere, Ford, GM, people buying trucks. Really, again, buying these investments buying these assets that really do lend itself to higher GDP and higher growth here in the United States. Okay? All right. Those durable goods, if you can, on the next slide here, on slide 15, durable goods spending in the U.S. reached a low. While even though it's rebounded a bit, it's well off its long-term average. So a swing, just a small swing in infrastructure spending could increase durable goods and actually increase our stock market by another 20 to 25, even 30% higher. Okay? All right. It'd be foolish of me not to admit that there's always cases for a bear market, and whether it be short-term bear or long-term cyclical bear. And again, I'm in the camp that I do think we're in a bull market for stocks. However, I do think we're in somewhat of a bear market for bonds. So for those of you who buy bonds or invest with us, for instance, like through our Archer Income Fund, we buy and hold. We're buying to maturity. So if we buy a 5% bond or a 5% yielding bond, we expect to get 5% over the next 5 to 7 years. Now, rates may move higher, and quite frankly, they probably will. So if you're buying bonds, you should be buying bonds and planning on holding them until maturity. Those people that buy bonds and then have to sell them after 2 years are probably going to be in for a rude awakening, losing money on their bonds. Just like this year so far in 2013, people have actually lost money in the bond market. Okay, U.S. Treasuries, if you own U.S. Treasuries, you've lost money. If you've owned corporates, you've probably lost money, and that's even with your interest. Or you're probably down about anywhere from 2 to 3%. So again, that's fairly normal. But let's look at a case for a bear market on slide 16 for the stock market. If we just said that nobody else is going to invest in the stock market, everyone's all in, nobody's coming back to the stock market, I would say that would be somewhat bearish. I don't think that's feasible, but it would be bearish. Housing stalls on higher rates. As rates move higher, construction spending slows and people don't build homes again. I don't think that's the case, although I do think housing will stall a bit as rates move higher once they get back to that 6% level, even 7% level. But at the same time, there seems to be a little bit of a pent-up demand for housing. Okay, let's say we get no earnings lift. Europe does not exit a recession. I actually believe Europe will exit the recession, and the last time that happened, it actually gave us about 16% returns for 3 years here in the United States, because obviously we do still export goods to Europe, and Europe does buy. However, Europe's been on a tough road here for the last several years, and then China weakens, and many of you have already seen that. I mean, China. If you watch 60 Minutes, gee whiz, they have cities over there that aren't even occupied. It's amazing. Huge cities. Now, China may weaken further, but at the same time, again, I'm not saying that the United States, we don't manipulate our currency, but frankly, China does that, but they do it, frankly, a lot better than probably we do. And I doubt China will weaken substantially. They may slow from a standpoint of not increasing as fast, but I doubt they will weaken substantially. Okay. This may be the biggest drawback to the stock market. and that's the Washington Hogs, a professional franchise who may start to play in Europe. I mean, basically, I think that's Harry Reid and John Boehner on there with Pelosi and some of the others and McConnell down below, but on slide 17. I mean, these guys in Washington really just have got to get their act together. I don't know if it'll happen. Frankly, I just see more of the same. Although, again, just one thing to remember: don't worry about the government shutdowns. The shutdowns are it's a fact that every time the government shuts down, we end up about 2.6% higher in the stock market 90 days later. And the reason is simple: if they shut down, they're not wasting as much money. I mean, it's amazing. I mean, you know, that we continue to reelect some of these bozos. Anyways, okay. We actually have seen a lot of overregulation by Washington, and you can see in the chart it's really pretty simple. And these regulations are costing companies money. And I think we've somewhat turned a corner that hopefully there's not a heck of a lot more coming down, or at least with the House and Senate split, that these guys will sit there and butt heads against each other and not get anything done. And frankly, that's good for us, the people. So just a little slide here on 19. The end of economic stimulus is near. We are going to quit tapering. Let's hope that we quit spending $80 billion of fresh new George Washingtons on treasury bonds and corporate bonds and assets and mortgage-backed securities and that sort of thing. Hopefully the Fed will stop doing that and quit setting us up for a bigger inflation number down the road. But that's another reason why I don't think bonds will do well. With that being said, one of the things that people always think of is they say, well, gosh, if inflation of treasury bonds move higher, isn't that bad for the stock market? It's actually proven to be otherwise. There's an equilibrium with everything, and everything finds its reversion to the mean. And what I mean by that is we've had basically artificially low interest rates. They should move higher. And typically, when the 10-year Treasury gets to be around 3-4%, and actually even 4.5%, getting towards 5%, the stock market does really well, because of what it means is that the government is interfering less, and things are working on its own. And so we should see some multiple expansion in the stock market. Amazingly enough, if I told you that the S&P 500 in 2016, 2017 was going to be 2,500 or 2,700, I mean, that's another maybe a 50% increase from where we are today. You'd be like, Troy, I don't know, that just doesn't make sense. 10% each year for the next 3, 4, 5 years. I'm telling you, it could happen, not only through multiple expansion, but because corporate balance sheets are so healthy. And quite frankly, earnings are going to move higher. And just remember this: inflation doesn't necessarily mean lower profits. Let's say if you own or if you buy Coke or Pepsi, and you buy a can of that Coke or Pepsi for $1 a can out of the vending machine, and now all of a sudden inflation kicks in, and that Coke can cost you $1.25. Coke may be selling the exact same number of cases of Coke, but quite frankly, their profits are higher. Their profitability is higher on that one can of Coke. They're not going to take their profits down. So they may be selling the exact same amount, and people say, "Wow, man, Coke is making a heck of a lot more money. They must be selling a lot of Coke." No, they're really not selling any more. They're just selling it at a higher price. Okay. All right. The next slide, I guess, doesn't matter because Larry Summers is now not going to be the next Fed chairman, but hopefully Janet Yellen will do well and get everything under control. This is what I was talking about before, and this is 2013. You can see, we thought the mid barrier on stocks was about 1765 on the S&P 500. We thought the low barrier was 1428. So we did believe that there was going to be a lot of upside in the market. And we do think 2014, again, we see about somewhere around a 2,000 to 2,050 ending price, and that represents about a 10% higher from where we are today, and actually a little bit more than that, about maybe 11.2%, something like that. So we think the stock market is going to move higher over the next 12 months and in 2014, and so our outlook's pretty positive there. As you can see over the years, I have not changed this slide. for quite a while, and we've been pretty right on the stock market. We've felt like we've understood where the stock market's going to be and where it's heading, and we know when there's going to be roadblocks and when there's not going to be roadblocks. And not to toot our own horn, but every once in a while you have to. Well, that's it. Again, my name is Troy Patton, and again, we work with CPAs and accountants throughout the country and work with their clients and managing their model portfolios, and we look forward to working with you or answering any questions that you may have at any time. And again, my name is Troy Patton, and you can always reach us at 1-800-800-1776. Thank you very much, and have a good day.